This case considered the issue of resulting and constructive trusts, and whether or not a trust was created when a finance company advanced funds into a bank account for the purpose of a company paying a dividend to its shareholders. In this case, a company applied for a loan from a finance company for the purpose of paying a dividend to its shareholders. The finance company had approved the loan and had paid the borrowed funds into a separate bank account in the company's name with a bank. However, the company fell into financial difficulties before it could pay the dividend and went into voluntary liquidation. The finance company sought the return of the money in the separate bank account to pay the dividend on the basis that the money was held on trust for the company in the bank account to pay the dividend, and since the trust had now failed, that the money was held as a resulting trust back to the finance company. They also argued that the funds were held on constructive trust for the finance company since the bank knew what the money was to be used for. The bank argued that the money in the account was not a trust and was merely a loan, and sought to retain the money since the company owed a substantial amount of money to the bank, and the bank wanted to offset this money against the amounts owed. The central issue for the court, therefore, was whether or not a resulting trust was created in favour of the finance company when the dividend was not paid, and whether or not at the time the bank accounts was established for the paying of the dividend, the bank became a constructive trustee for the finance company. The court ultimately held